Get your money out now. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, an external force is now threatening to topple the U.S. banking system, and I want you to see why your bank might be next. Because based on what data we're seeing, and I'm going to go through some of the recent data here with you as we get into our headline story, that I think the U.S. banking system is really close to seeing another bank failure. I believe we're on the brink here. So let's go back here a little bit into the data. We'll set the stage for you, and if you're wondering what we're doing in Japan, well, our external force starts there. Here we start out with details, and multiple reports are telegraphing that inflation will become a big issue in the months ahead. And this is really the kind of the crux of the story, is because all of a sudden you see central bankers around the world are not looking at growth anymore. They're so fixated on inflation and bringing it down that they can't see the damage not only internally that our own Federal Reserve is causing to our banking system, which we'll look at again today, but we're seeing now external forces are putting major shocks on our banks. The only question is, how big of a hit can they continue to take before the next one fails? U.S. inflation indicators have simmered down in recent months, but increasing economic activity will put the heat back on. That will bring a rise in short-term rates and deeper inversion in the yield curve. Now, let's unpack that for a brief moment here, because what this article is suggesting is that inflation is going to come back. And I want to make the case that this is not going to happen, or at least not in a material way, that's going to cause the Fed to further raise short-term interest rates. But notably, it mentioned that it will cause a further inversion of the yield curve. Now, what we know is that when short-term rates are higher than long-term rates, which triggers the inversion, it's because long-term rates are suggesting that the growth and inflation expectations in the future are far lower than what the Fed or central bankers are projecting in the short term, which is why they're raising rates. So this doesn't make any sense, at least for what this author is saying. Investors have been giving false hope with softening in key indicators such as the CPI, PPI, and ISM price paid indices. That's good news, but shouldn't be overinterpreted. Details in multiple Federal Reserve surveys, which we've looked at on the show, and we're going to look at again now, and PMI reports are telegraphing inflation will become an issue in the months ahead. And what they're suggesting is that inflation is going to magically come out of the factory sector. I'm going to make the case that's just not true. Services manufacturing, and we do have a chart of the Philly Fed that we're going to look at, our own chart, and even small business reports give a consistent message. Business is going to pick back up in the next 6 months, and with that in mind, companies have already caved to strike demands, and many have plans to raise wages and compensation to lock in an ample workforce. This will continue to bolster the U.S. consumer, already the most confident in 2 years, and that will complicate the path of U.S. interest rates. And so you start to think about the banking system here, is what they need is a normalized yield curve here. They need long-term rates to be above short-term rates. And here this one expert saying, no, that's not how we see it. We continue to see the short-term rates are going to be higher than long-term rates. Inflation is going to continue to be an issue. We're going to see further upward pressure on short-term yields. Now, the only question remains is, at what point do we see another bank break? Even though the professionals here, we see the experts, the politicians, and the policymakers say we've dealt with it, but we know that they haven't dealt with it at all. Let's take a look at this chart from the Philly Fed. Let's address this inflation issue, because this is key in where we're going with our headline story, is that inflation is not magically coming out of the future. It's actually going to abate and continue to cool off just as we would normally expect it to. So here we're looking at the Future General Activity Diffusion Index for the Philly Fed. Now, what this is this is a survey, and what you're seeing is purchasing managers projecting where they're going to be 6 months from now. Now, they have no actual data, but one thing we can note is when things are really bad, people tend to say, well, they can't be worse, so they're probably going to be better. Keep that in mind. This is outlook for the next 6 months against inflation. What I want you to notice here, there really isn't much of a relationship, at least not in the one that people would expect, because what the article is suggesting is, look, the factory sector is going to surge higher, and that's going to cause inflation to go up. But what we can note is that when future expectations rise, well, inflation shown in red comes down. In fact, you can see it repeat over and over again here in the early 80s. It did that. It did it in the early 1990s. Again, future expectations up. You'd think inflation, you'd think growth, and nope, the opposite tends to happen. In fact, you see it repeatedly, and here we are again suggesting that things can't get worse, so that means inflation's got to go higher. Well, suggests it's going lower. And as we look at the general business activity index, what we know is that it's a better predictor of where inflation is going. In fact, it tends, often you see the factory sector go down. There's kind of a transitory increase in inflation, and then it comes down. And you see that repeat again here in the late 80s, early 90s, it repeats. We see it again in the dot-com bubble, the global financial crisis. Again, manufacturing sector falls down, and then the consumer price index. Again, this is a demand issue. What you're seeing is exactly what you'd want to see here is supply and demand. Demand goes down, and eventually that gets into the consumer prices, and then their price growth slows. That's a key point. And so here we're seeing that happen again, and our expectation should be that inflation comes down. But is there any real correlation between the future activity index and the current one? Well, it's exactly what we kind of expected to be. When things are at their worst, well, that's when, of course, the future predictions are really high. And we see that kind of repeat over and over again, suggesting that if future expectations are rising, well, it doesn't mean in the current sense that things are going to necessarily get better. It just tells us that inflation is coming down and that these purchasing managers are looking at the data saying, well, I just can't imagine that it could be any worse. And that's actually a good sign, but it doesn't solve the problem with what's going on with the banks, because remember, the Fed and these other central bankers are fixated on inflation, and what they can't see is just how close the banking system here, at least in the US, is again to breaking. As U.S. inflation cooled while consumer spending picked up in June, and one thing that should be picking up is your trading account. Now, some people have asked us, can you trade things like crude oil with it? Well, you certainly can. We cover crude oil in the report every day, and we'll show you this example. We see crude prices came down from 83 down here at one point down to 67, and I want to show you in our report, our CTA-Timer report, that it actually pulled this move down and then re-signaled a buy right here. See this little red candlestick? That was when it was the last signal that says you should buy if you haven't yet. If you trade this, that would have put you in around 73. You'd see over a little $6 price gain, which is pretty good. Going back to our June 28th report, we can see that the machines were still net long. They sold down to a 15% position on our fast and our slow signal, but it held that for several days as price rallied. That is your signal because the machines are trend following. Here you can see on 710, that little red candlestick, the fast algorithm went max long, and that's usually our signal. If you don't see it go from max short up, you look for a different signal to get max short, put out a nice $6 trade in crude. Again, link in the description below. It's $30 a month, $1 a day. One trade could pay for your whole annual subscription. It's pretty amazing. Now let's continue and look at this setup here of why the banks are in such big trouble. The personal consumption expenditures price index rose 0.2% last month from May, showing that inflation is starting to cool off still from a year ago. A measure that the Federal Reserve uses to track its 2% inflation target increased to 3%, the slowest pace in more than 2 years. So again, you see this case, inflation's cooling off. The so-called core PCE, which economists tend to see as a better gauge of inflation as it strips out food and energy, also rose 2.2% from the prior month and slowed to 4.1% from June of 2022. Consumer spending, adjusted for inflation, increased 0.4% in June. We'll show you why, the most since January. So again, we continue to see the trend here that the personal consumption expenditures, now this is the Fed's preferred gauge, and you're wondering, well, how does this relate to the CBI? Well, they're almost the same. As you can see in this chart here, personal consumption expenditures against the consumer price index in red, they look almost similar because they are almost similar. So what we're seeing here is they're both continuing to cool off, putting us right on trajectory to hit the Fed's 2% target and probably overshoot it to the downside. But really, the relationship isn't wages, as of course a lot of the experts want to suggest. The real input that matters is U.S. regular all formations gas price. And while we're hearing in the headlines gas prices are up on a year-over-year rate of change, they're not up enough to change the overall trend of the fact that the PCE and the CPI are lagged to the downside. Now, you're still wondering why I'm focused on the CPI here. It'll make sense in a moment as we get into the head story. As real disposable income, the main support to consumer spending, rose 0.2%. Remember, real being inflation adjusted. Wages and salaries, unadjusted for price changes, increased 0.6%, and the biggest advance since the start of the year. But notably, look at this little sentence here in the end. The savings rate, this may be more important, fell to 4.3%. So here again, it's all about inflation. Growth is coming back. Wages are still going to rise, and that means that we need to further tighten monetary policy without any regard to what you're going to see is going on with the banks. And then we get this shock from this external force. It just is not a good sign. But let's continue on, because I want to drive this point home that inflation is going to come down anyways. And I know many of you don't agree with me, and that's fine. But look at this, real disposable personal income. So you would think that if inflation adjusted income is rising, makes perfect sense, that inflation should rise because consumers have more money to spend. Well, look at this. Almost in the opposite sense, we see that when real disposable personal income is rising, well, inflation comes down because we've got the consumer price index in red. In fact, you see it happen again here in the early 90s. And then you'll notice that personal incomes were fairly steadily growing here in the early 2000s. Inflation came down. You see it here during the global financial crisis. We see it here around 2015. And guess what? We're seeing it here again, suggesting that that's not the driver of what's causing the problem with inflation. But look at the personal savings rate. This is neat because what we note is a personal savings rate is ticking higher, although the growth of it slowed a little bit, suggesting that maybe consumers tapped into their savings. That was what's causing maybe a little bit of this be a boost in gasoline prices here over the summer. And it makes sense. This is a time that consumers typically would spend as we head back to school pretty soon. But let's look at this chart, because what's notable here is when consumers start to increase their savings rate, build up their buffers because they spend it down, look what happens to inflation. With a lag, it comes down. You see here again in the 80s, savings rate going up, inflation coming down. You see it in the 90s, you see it in 2000s, you see it in the global financial crisis, and you're seeing it now. Now, it doesn't have to go up in a straight line. It just means that consumers are starting to rebuild their savings. And so we come back to this supply and demand concept, is if people are building their savings, it means they're spending less. So the whole narrative here, the whole point I wanted to make as we get to our headline story is inflation was cooling off, and it doesn't rapidly fall. It's not like you're up in an airplane and drop a rock and it goes straight down. Inflation is going to come down at a reasonable pace with a lag to the data, and that's what the central bankers don't understand. And because of that, we just got hit with an external shock and is going to have serious issues with our banking system. And now let's take a look. As the Bank of Japan, this is where we're at. You see, notice the background. We're in front of the Bank of Japan right now, since yields soaring with surprise change to the rate limit. Now, look at this. The BMJ kept its target for 10-year yields around 0%, but said it was 0.5%. Ceiling was now a reference point and not a rigid limit, as it sought to make its ultra-loose monetary policy program more flexible. The bank said it will now offer to buy 10-year debt at 1% each day, even though there's really no offers at that, suggesting an effective doubling of the movement range for yields. And what happened is that sent shockwaves through the financial industry overnight, or during actually Thursday, because the rumors they were going to do this, it sent yields up. Now, if you start thinking about this from the bank's perspective, what is the big problem these small and mid-sized banks have? Like their biggest problem right now, well, one of those deposit flight, you've got that. What was the other is those unrealized losses on those treasury securities. So here we can see the Bank of Japan putting stress on the U.S. banking system is now those unrealized losses overnight just got bigger for banks who don't need any more problems. While the BFJ left a short-term policy interest rate unchanged at minus 0.1% and said the moves didn't represent a step toward the end of its yield curve control program, some investors were unconvinced, clearly by shorting the bond market. Japan's benchmark bond yield surged to the highest since 2014, and the yen jumped as well. Now, the question you might be wondering why this is causing an issue is with U.S. yields and global yields. Well, check this out. Speculation of yield curve control changes has continued to simmer since late last year amid a global wave of policy tightening to rein in inflation. And that's why I did this setup here. I wanted to see that inflation was going to come down anyways. And despite that, these policymakers just seem convinced that they need to do more and more and more to bring it down when they can't see what they're doing to the banking system. And that's nearing its end after the Federal Reserve and ECB hiked rates again this week. The BOJ has closely watched the driver of the markets around the world. Here's the key part. In part because Japanese investors are major holders of U.S. government bonds and own everything from Brazilian debt to European power stations. So the reason this is impacting the U.S. debt markets is really simple. Is Japanese investors love buying debt. They love buying government bonds. They love that. And in order to buy foreign debt, such as the U.S., they have to hedge that. There's currency risk involved. So now the fear is if the Bank of Japan lets the JGB rate rise, well, foreign investors won't need to buy U.S. debt. They'll want to sell that, putting upward pressure on U.S. rates as they go and purchase bonds in Japan. Of course, we know that that's probably not going to happen too much because the Bank of Japan is unlikely to let this go for longer. But what's happening, Ian, is now you're seeing the stress on the U.S. banking system. In the latest forecast released with the decision to show while the BOJ now sees inflation averaging well over 2% this year, look at this, it doesn't even buy its own narrative. It predicts it will weaken below the target in the next fiscal year. This suggests the bank may need to keep its stimulus going for longer, perhaps reversing the decision today. And during the press conference on Friday, Uda repeatedly said the distance remains to achieving the BOJ's stable 2% price goal, which they're unlikely to do. So now let's go in deeper into the U.S. banking system because now you see the external threat. You have the possibility Japan could further raise rates there or let their bond yields rise, which could cause foreign investors to pull their money out, driving U.S. yields up. That puts pressure on the U.S. banks, particularly the small and mid-sized regionals. But now look at, because of the Fed's decision on Wednesday, look what else is going on. Here we can see the overnight reverse repurchase rate is at 5.3%. Now we know there's a haircut the money markets take off of that for their operating costs, and that's putting pressure again on those small and mid-sized regional banks as well. And so they're going to face a double whammy. They're going to see their unrealized losses go back up, and now they're going to face further deposit flight. So the question then becomes for these banks is they need to offer their depositors higher interest rates. And here's another issue is we're seeing loan demand go down. And taking a look at the weekly commercial industrial loan data, here we see on the year-over-year rate of change, it's down to 2%. And I've been telling you this was coming down. At some point, it's going to go negative. And one of the key factors here, what I want you to see in this chart, is that when banks originate new loans, that's new money in the economy. If they have a negative effect, that means money is being paid off. So when principal value of any loan, whether it's through a payment or lump sum, and when principal money is paid off, the money is destroyed out of the system. So a contraction in commercial industrial loans, not a good sign at all. And we know it's going to get worse because as the inversion gets deeper here, and we can note that even if we see rates fall, it doesn't matter. The banks are going to further tighten lending standards, and that means fewer loans, less money created. And of course, the end result here, you're kind of wondering, where does all of this go? Is the banks need to see rates fall, or they need to see rates rise. Either the long end needs to go up, which is what the market believes. That's why there's so much short interest on the long end of the curve. The market believes the Fed is right, or banks need to see the front end of the curve fall. And here's what's interesting. Not many people believe long rates are going to fall here, but what we can note is historically, when banks tighten lending standards, even if the Fed isn't cutting rates, and they don't have to cut rates, you can see the long end of the curve goes down and eventually makes new all-time lows, suggesting that the 10-year Treasury yield could easily go to zero or to negative, and that would be a major shock, of course, to the markets and the Fed, who thinks inflation is a problem. And all my point here is when that happens, we're going to see more banks fail because they don't have the deposits to hold on to. They're going to have to go to the Fed or go to the Federal Home Loan Bank and borrow money at big, high interest rates, and they have nothing they can do here. The more stresses against the system, it's not only a matter of time before another bank fails. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.